Hold on, I'm clicking, I got it. Set. Perfect. Great. Thanks, Ayaan. Okay, so thank you. I think this is like the proof that we've all made it to the end of the semester, and now I get to do some things that are more fun than whatever end of the semester teaching and administrative wrap up we have, and I get to sort of move into research. So the paper is titled The Measurement of Quarterly Earnings Integral versus Discrete Method, and it's joint with Colin Coatney and Lillian Mills. And how we sort of got here is just in a lot of other settings in both tax papers and financial papers. I felt like I was regularly bumping up against some idiosyncrasies in quarterly earnings measures beyond some of the things that we often talk about, like fourth quarter true ups. And so the big picture question we're interested in is which quarterly earnings measure has the greatest decision usefulness. And so I have these two pictures that describe, I think, how the measures were thought about in the standard setting process. And so in the US system, the Accounting Principles Board described quarterly earnings as an integral method, with this idea being that a quarter was an integral piece of the whole year. And so to some extent, which the graphic is kind of set up to display, they were thinking about quarterly earnings as representing a fourth of the year. And but in the discussions, they acknowledge the alternative, which is that a quarter is a discrete period. And that is the method that IFRS adopted. And so each quarter, firms are instructed to measure the events of that quarter without considering expectations around other quarters. And by the way, pop in with your comments. And I asked Yuan if she would help me not miss hands, but feel free to just unmute and ask the question, or Yuan will help me hopefully catch the chat so I don't just miss things, because I think mostly the benefit of this great audience is getting some help thinking about what we can do better. So why are we interested in the measurement of quarterly earnings? And so these alternatives were both debated quite a while ago, actually. So we're almost at 50 years of these. And then IFRS, without a lot of debate, adopted the alternative measurement, but they're quite different. And these changes over time in the US, a significant increase in what we sometimes call special items, or one-time or transitory items, and that effect on non-GAAP reporting are two things that have cropped up. And so some of the choices that are part of integral accounting seem to show up a lot in how we measure earnings and report earnings. And so I think that's kind of where my fundamental interest came, is this decision to have firms.
This is a test.
Yeah, there you are, Josh. Do you want to pipe in, and do you have a question or a comment? Okay. So I think fundamentally what we're interested in is whether or not the measure is accomplishing the ideas that the standard was intended to accomplish. So a couple of kind of things about this are probably, I'm going to say, discrete too many times. And one of the reasons for that is IFRS adopted a method that is termed a discrete method, that each period is discrete and independent. But in the US, in the quarterly accounting method, there's a series of items that don't get integral treatment. They don't get smoothed out over the year with a quarter put in. The full amount of those individual items have to or are supposed to be recognized in the quarter individually. And so I've got both discrete items, which are kind of a US thing, and a discrete method, which is the way I would describe IFRS. And so we're going to deal with those discrete items in the US setting, but it's not our primary interest. But I'll talk a little bit about some things we try and do with it. And hopefully I'll make sure I'm really careful to specify whether I'm talking about IFRS and that discrete method. And so you're not thinking one-time charges. The other issue is kind of how are we going to measure useful? So in the discussions around APB 28, their focus was on the usefulness of quarterly earnings in helping firms predict annual earnings. And so that's our starting point in thinking about predictive ability. Is it useful for predicting annual earnings? That's not the primary use, though, of capital markets participants. They're often using it to predict earnings 4 quarters ahead, or using 4 quarters ago to help predict this quarter, however you want to think about that. So we started with predictive ability, and it also, one of the benefits, I think, from my perspective in focusing on predictive ability is it lets us look at some other measures and how they might work. But one of the suggestions we had from an editor in this process was to think about information content or value relevance to the markets. And so we've added that to hopefully triangulate our results. Okay, so our initial design that I'm going to show you some of what we think about is just a very straightforward predictability model. And we did not include a lot of additional controls because we want to focus on the R squared as the interpretation of the model and not differences those controls create in the R squared. And so we're going to match our samples of firms to address that. So we're going to look at 4 quarter ahead earnings predictability and annual earnings predictability.
Cristi, I think Ayang has a question.
Perfect, Ayang.
Cristi, my question is very basic. What about the what's integral method? What's discrete?
Yeah.
So in terms of like thinking about and then across line items within earnings, from revenue to cost of goods sold, SG&A, to kind of like special items, non-recurring or non-operating items. Like, is integral something that you estimate and then try to allocate across the remaining quarters, and discrete means that you just truthfully report whatever you observe?
Yeah. So
if it's transitory, later you reverse it.
Yeah. So this is a great question. Yeah. Okay. So across, kind of thinking down the income statement. So thanks for the way you framed that. Revenues are not something for which there is, at a basic level, sales are not something where the integral method is really applied to. I'm going to ignore for just a minute things like returns and accounts receivable, but revenues are recognized in the quarter in which they arrive. And so the majority of the integral method's estimation affects costs. And it affects costs in a couple of ways. So let's start with cost of goods sold. And one example of that would be that firms' inventory fluctuations are ignored if they expect them to reverse by year end. So for example, applications of FIFO and LIFO, a decrease in inventory levels wouldn't trigger a LIFO liquidation if the firm expects to restore its inventory levels. That's obviously an estimate or an assumption about the firm behavior. If you were accounting for those same inventories under IFRS, you would recognize, okay, this is the fuzziest, this is the least accurate thing, hopefully, that I say all day. There's no LIFO under IFRS, but if you had LIFO under IFRS, you'd go ahead and recognize that liquidation right then, right? So we dropped all those LIFO firms to get around that, but to get around that specific thing. But I think that's one that US accountants are quite familiar with is, well, what about inventory level drops? Well, you ignore them. Also in cost of goods sold, if you're allocating costs over the year and you have slowdowns or heavy periods. So in manufacturing, they often have ramp up periods, and then they expect to offset that with deader periods, for example, right around the holidays or in a dead period in the summer. And so they would ignore those fluctuations and average those costs out over time. And then the other set of costs that you mentioned are SG&A. And under US GAAP, we see recognition over 4 quarters. And in particular, we see recognition of expected costs over 4 quarters. And so what they're allocating, so one example that we have in the paper and probably need to write a little bit better is that I think is a little bit straightforward is the audit fee, not the known audit fee, but sort of the expected audit fee. And US firms allocate that over 4 quarters. Under IFRS, you allocate that to the periods where the charges occur. So exactly where the work is done and it's charged. And so you don't have that same sort of expected feature and then that true up at the end of the year when your audit firm says, by the way, we have to do some extra work. And so we're raising the bill. And then you true those things up. And then the last thing on your list were these kind of one-time charges or special items. And under both systems, most of the things we think of, so gains and losses, impairments, litigation settlements, those are all recognized in the quarter in which they occur under both US GAAP and IFRS. Is that a good list? So we're mostly focusing, I think we're primarily interested in and focused on what I think are the day-to-day operations and the things that we think of as being informative about a company's performance, that the primary differences between the integral and the discrete method are around a company's core operations. And while there are definitely issues around special items and true ups, that's not our primary interest. Our primary interest is in how well these two methods report what I think of as being the critical piece of earnings, the core performance. I probably should switch the order of these slides, so I'm going to just do that on the fly. So we're interested in comparing the integral method, which I think of as the US, and the discrete method, which I think of as being IFRS. And because there are obvious differences between US and international firms, we're going to match on size, firm size, on their industry using the FAMA French 12 industries. And because we're interested in how well firms are able to apply these methods, we want the uncertainties around earnings to be more similar. And so we're going to match on annual earnings predictability. And Young raised a really important question, which is about how these two standards apply to numbers. And so we're going to use the predictability of revenue as a benchmark. And so when I get to the results, one of the things that was important to us is that not necessarily that the revenue predictability be the same across the groups, it isn't always, but that it not, when we find that US GAAP is better, it turns out that IFRS revenue predictability is actually higher. And so we feel more comfortable that it's not just the predictability of earnings that's driving the underlying similarities. Okay, so what do we expect? So at one point in the paper, I feel like my papers are sort of like my children. When this paper was really early, sort of the ugly baby with cradle cap phase, we got a couple of suggestions that we think about a more rigorous model. When we put the model in, but also started writing the paper better, I think the duh factor of the stylized examples and models became really evident. So right now I have a little bit more of the duh factor version of this, where my toddler doesn't need so many bows to make you think she's cute. So when annual earnings are highly predictable, so if we think about a firm where what is happening during the year is likely, so if there are any deviations that occur in a quarter, they are unraveling before the end of the year. Because what we see on average is the earnings in one year are mapping into earnings in the next year. So any sort of deviations are resolving within the year. And that's what the integral method was really designed to predict or smooth out. Young, I can see your hand, so let me finish this explanation about integral method, and then I'll answer that question. So when those things are resolving during the year and annual earnings are highly predictable, then we expect that what would happen in the US is that you would have some sort of deviation in a quarter. And because under the integral method, they can ignore that because they expect it to smooth out, then US managers would just ignore that. And so they would, and it would smooth out by the fourth quarter. And so they would report their earnings and there wouldn't be any deviations. And because those things smooth out and they don't carry over into the next year, then the predictability of earnings should be high because the manager ignores those intra-year blips. What happens under IFRS, though, is that blip occurs in the second quarter. The discrete method makes you report it, and then it reverses in the fourth quarter or the third quarter, and IFRS makes you report it. But it doesn't carry into the next year in the same way. And so we would expect that GAAP would be superior. It would have higher predictability because managers are able to ignore those blips, whereas the initial quarter and the reversal quarter would be noisy for IFRS. And underlying that is an assumption that managers are able to see or to estimate correctly that those blips are reversing. And if they aren't, then the US manager is going to basically do the same thing as IFRS. Okay, Young.
So I have like questions or suggestions based on your previous slide. I think you lose observations based on your matching. Have you thought about using like more like a balancing, entropy balancing or something without losing your observations? Right?
Yeah, so
easy thing I'm speaking to the co-author who's on the call now.
Yeah, I'm sure Colin is thinking.
Colin is.
Yeah, Colin's thinking, thank you, Young, for that suggestion. I think if we were not focusing on the R squared of those regressions, that option would be a lot more palatable to us, but it has a lot of implications for our ability to interpret the differences in the R squared across those models. And so if we want to use the R squared, how much it's explaining. And I think our bias when we started Young was that we didn't think the coefficient, the magnitude of the persistence was as meaningful in terms of the way the APB had thought about quarters. So we didn't have in our mind this idea that, for example, a quarter needed a coefficient of 4 into the annual earnings or 1 into 4 quarters ahead. So if that's something we could think about, because I agree, we shed some observations there. I sort of like the R squared, so I have to think about that. Is the problem with the rebalancing is it makes the comparison across each of the quarters and models difficult because they're not estimated on the same proportions. Yeah. Jonathan.
So I have
sorry.
Sorry, I have a second one is that I think, have you thought about using some stock returns or other non-examined firms metrics as a benchmark? So your earlier response to me that the discrete will be report whenever it occurred in that specific quarter, it seems to be a most pursued type of the measure using stock returns or other independent indicators to as a benchmark to see. I think discrete approach number will be more correlated with a frequently updated stock returns or other independent metrics than managerial estimated allocated numbers.
Yeah, I hadn't, but that's really useful because I think our biggest worry is that we didn't want apples to oranges, but maybe we've only managed to get, red and green apples or, 2 varieties of apples that still aren't highly similar. And so that might give us another way of increasing the similarity of the samples. Yeah. Yeah, thanks. Okay, now Jonathan, sorry.
Yeah, it occurred to me that, maybe one way to frame this is if you think about earnings smoothing and go back to Dembski's story from about 20 years ago, sort of which method, helps you better convey managerial expertise in terms of their ability to use their crystal ball to see into the future. I think it's pretty clear which direction that leads, but it's one theory that could be relevant in helping you think about the results.
Yeah, and I think there are a few papers, and I know Josh Ronan had sent me his. So I think you're thinking about this more. Okay, if we go down that path, does that shift some of what we're testing into whether the managers have sort of equivalent ability, but the system allows them to signal? So do I have an assumption underneath that they're kind of both equally able?
Well, I don't, when you say both equally able, I mean, the whole idea is that there's some sort of signaling ability, that you
Right.
are able to signal through your ability to smooth earnings, and that the reporting system would make that more or less difficult or more or less meaningful as a
Right.
signal.
So
And
my
to think about-
managers have equal ability, but the systems facilitate that ability
Yes,
to
yeah.
differential degrees, right? So
Yeah.
that doesn't get me in trouble with their respective abilities inside their systems. Yeah, thanks. We didn't talk very much about the nice thing about that suggestion, Jonathan, is I think that that moves us closer to things the FASB is thinking about now. But it's not what was, the APB was awfully narrow about how they described it. And I think that bridges also to some of the current literature a little bit better. Okay, so we want to partition by the predictability of earnings, and we would expect GAAP to be superior there. But when earnings are not very predictable, then the US manager is trying to apply the integral method, and we would expect them to ignore those fluctuations. But because they're not reversing within the year, which is one of the implications of lower predictability, is that those things that are occurring in year one are not occurring in year two in the same way. And so those reversals are occurring in year two, and you have different offsets. Then what happens is that the IFRS manager records the initial shock when it occurs in some quarter, and the US manager waits and probably records it in the fourth quarter, typically when they realize that it's not reversing. Okay, so superiority here is a little bit harder to think about on. It has more variation to it. It depends in part on the extent to which the shocks persist and the likelihood that they recur in the same quarter. So if they recur in the same quarter, then IFRS is superior and persist to a higher degree. If they're not as persistent, if they're one-time shocks, or if they are occurring randomly over the quarters, then we're likely to get more similar adjustments. But we think the GAAP fourth quarter is likely to be particularly noisy, meaning all of it's going to hold all of the adjustments. And that would be consistent with a lot of prior research on quarterly earnings in a variety of settings where we go, oh, the fourth quarter is highly noisy. And I think that's pretty well established. The question for us is whether the GAAP fourth quarter adjustments are significantly worse than IFRS. So do you see more of the manager, are things occurring in the fourth quarter or being handled in the fourth quarter? One of the things that we don't talk about a lot in the paper, but it underlies our thinking about the paper, is if nothing is happening inside the year and no one-time things are happening outside the year. So if earnings are perfectly predictable across 4 quarters, they're 25% of the annual, or some sort of predictable pattern, then the two methods really shouldn't yield different outcomes. And if firms both under the discrete method and under the US integral method are experiencing a lot of those one-time transitory charges that Young asked me about, those get accounted for immediately under both systems. And so again, if that's the primary source of differences, transitory one-time shocks, we also wouldn't expect a large difference between US GAAP and IFRS reporting. So it is important to us that we match our firms well enough that the incidence of those one-time shocks is similar, and that our measures allow us to focus on the core earnings reporting and not those one-time transactions. And I appreciate Young's comment, because I'm not sure we've gotten there. So if there are things that you think about, I'll show you in a little bit, but so let me tell you what we find. We do find that GAAP is significantly better than IFRS across all 4 quarters for predicting earnings for firms with high annual earnings predictability. So that's that smoothing, that ignoring of earnings signals provides better prediction for 4 quarters ahead. And when we look at firms with low earnings predictability in 3 of 4 quarters, we find that IFRS is significantly better than US GAAP in predicting 4-quarter earnings ahead. So that recognize it now. And I think you can see in the tables, you have the amount, but I think you can see in the picture, the gold bar in the 4th quarter is quite a bit smaller. You can see that drop off from predictability for US firms in that 4th quarter as they true up. But you can see across the quarters that what a difference that true up makes in the pattern across US firms and IFRS firms in the usefulness of earnings for predicting earnings 4 quarters ahead. Okay, so annual earnings was actually the objective of my mind just blanked. Annual earnings was actually the objective of the APB when it set in place the standard. So this is annual earnings. And the first 2 pairs, the first gold and green bars in each quarter are high predictability firms. And we find a small but not particularly meaningful difference in quarter 1 for US GAAP. But the firms are actually quite similar. The methods are actually quite similar in their annual earnings predictability, except in the 4th quarter, when all the information is known. And so that degrading of predictability is probably not something that FASB considered super important. But that true up, as we know, is going to cause lots of problems. But that smoothing of earnings creates higher annual earnings predictability for low predictability firms with lots of variation. That smoothing of a quarter makes the quarters more predictable for the annual, except again in that 4th quarter. So this is somewhat consistent with the APB's objective, and I'm going to attribute that to the FASB, who's also carried it over without making any changes. But it left some questions for us about, so a couple of things that we thought about as we were moving through this. So I'm going to switch to a couple of things and not worry about the takeaways, because I think my time telling you what I think we found isn't as useful as insights you might have into things we can do better. So one of the things we worried about is whether we were looking at the right target. Bjorn, I can see your hand. I'll finish what I'm saying here, and then you'll probably send me back a slide, but I'll keep my train of thought for just a second. When we initially did this, we took as a given that these earnings numbers are being used and are viewed as useful. And so we didn't start with this idea that what we were measuring was, well, what if a firm just reports 1,000 every quarter, and then that's highly persistent every year with some 4th quarter true up. So we started with this premise that these earnings numbers are useful and used, and so we used each earnings systems number as its own predictive benchmark. And, you know, the dream data we wish we had was each one of these firms' data under both systems, right? So if I could invent the data I wanted, I would, of course, like to have the data for Unilever under both systems, and I'd like to have the data for Coca-Cola under both systems prepared, you know, correctly and properly. But we also looked at the predictability of these numbers, both GAAP earnings and IFRS earnings, for street earnings, which is just analyst actual earnings as reported in IBIS. So with some I'll fully admit some sort of black boxish set of adjustments, but they're, plus or minus close to non-GAAP earnings and also to cash flow from operations. And we generally find that GAAP earnings does a better job of predicting street earnings for high predictability firms. And we also find that pretty similar results for GAAP earnings when we take out those discrete items. Okay, so Bjorn.
Thanks. So I was going to ask you, it's around footnote 5, the issue with tax and tax expense.
Yep.
So suppose you took the tax expense by quarter and you calculated the book effective tax rate and the cash effective tax rate. Do they have some patterns? You say that there's the integral approach based on the estimated or anticipated tax planning and tax rate changes. But I guess I could imagine that it might be the case that on a cash basis, the effective tax rate by quarter varies differently than or predicts differently than by the GAAP book. Is that called book effective tax rates? Book ETS?
This is a good question that you're asking. I think you're asking about data that tax researchers have been coveting for a while.
Yes.
Because the cash taxes paid are not consistently reported on a quarterly basis. And so researchers are usually hamstringed to only having annual cash effective tax rates, not quarterly cash effective tax rates. But I think you're asking me if I had that, would we see a difference in the pattern? Is that right?
Yes. Yes, because in the annual report, the cash taxes paid is a mandatory disclosure for US firms, right? But not in the quarterly report is what you're saying.
Right. For US firms are not required to report and do not with much consistency report cash taxes paid on a quarterly basis. There are few that do, but it's not widely reported. I have to think a little bit more about that. That is actually how we sort of got started in thinking about quarterly reporting. It was this notion that firms are sitting around guessing their ETR over the year. And let me think about that more. I do think the cash pattern for US firms is much more volatile, and that's triggered by the timing of some of the cash payments. They're heavier for a calendar year-end firm. They are heavier in various periods to make sure they're not underpaid. But fortunately, 2 of my colleagues are really good at this. And so we can give that 5 more seconds of time and round out that footnote. And Peter asked a question that is,
thank you.
Thanks. Completely right. Quarterly reporting, and you can see it. Peter, I don't think you missed anything, but you can see it in the data table in table 1, panel B, the countries that we include in the sample. It's disproportionately Scandinavian, and they have more firms that report on a quarterly basis. So we did require IFRS firms that are quarterly reporters. And I agree, so they are, so some of them are self-selecting into quarterly reports. And I have to think more about which way we handicapped that. I think initially I thought that might handicap it in favor of IFRS. I have to think about whether we've done that. So I made a note that we need to go back and think about that more. And if you have another thought about that, I think that's fair. We're requiring them to have quarterly reports. So that's completely on target. Josh, I see another hand up, and hopefully I didn't miss more.
Yes, so hi, Cristi. So my question is the following. There is some evidence that firms in the US adjust fourth quarter earnings such as to make annual earnings smoother.
Yep.
To the extent that, and I don't know about any evidence related to the IFRS to the extent that the objectives of firms outside the US is the same. That is, adjust fourth quarter earnings in order to make annual earnings smoother, such as to facilitate the predictive ability of annual earnings based on annual earnings. So any 1 year's earnings would better predict future years' earnings. What is the implication of that practice to your hypotheses regarding the integral versus the discrete?
Yeah, okay, so I saw this, and so first of all, clearly I need to go back and cite one of Josh's papers that is specifically about this behavior. And so we'll go back and we'll tag that in. So what's interesting about the smoothing that you're talking about, so this is, I think Josh sent me a really nice email with a link to this about 15 minutes before this started. So this is, you're getting, I have, 2 brain cells that have been applied to this. But my first reaction, and I went, oh, that's not the smoothing I'd worried about, because the smoothing we'd worried about or thought more about was the smoothing across quarters that I think the integral method's designed to facilitate. And you're talking about the fourth quarter, which I think is the messiest quarter for me. It includes both true ups, and as you note, it's the last quarter that firms can use to achieve their annual earnings objectives. And the thing that I hadn't thought about that's quite nice about that is, I think you're correct that while the true up is probably a US only phenomenon, the interest in smoother annual earnings is not limited to US firms. Annual earnings predictability might be a shared objective. So I think that actually might give us a way of better differentiating the effect of the integral method from what managers are doing. And I think we can go back and look at that a little bit more. I think the implication of that change is maybe a little bit unrelated to the integral method, in the sense, or the difference between the integral and the discrete method. I don't think that one method facilitates or detracts more or less from that, unless you think it's easier to hide that smoothing under one of those 2 methods. And my quick, mental math was, I think you can do it under both of them, because the discrete method is bouncing around and the integral method has true ups in the fourth quarter.
So in both cases, under the integral or the discrete, if indeed firms' objective is to smooth annual earnings to facilitate the predictability of
in
annual
Q4,
earnings, both FASB, in other words, both IFRS and the GAAP, then the implications for what you observe in the fourth quarter earnings as related to the first 3 quarters, that may have different implications to the predictability of fourth quarter earnings in the 2 systems. So in other words, it may modify the hypotheses regarding what you would observe during the quarters within a year.
You would expect 1 through 3 to be quite different from 4.
Yes.
Yeah, I think so. And we honestly, when we started on this, the only consideration we'd given to Q4 was, well, the US firms are going to dump all their true ups into Q4. And I like your story. Your story's more interesting than something I already know, which is dump a lot of true ups into Q4. So I think we need to go back and look at it. But you said, okay, so I'm the thing I can't quite figure out what I am thinking, what the relation is between Q1 through 3. So I need to go read your paper again. I need to go read your paper, which I think I said once, but I'll say it again. What is it about Q1 through 3 that affects the fourth quarter true up? Is it the extent to which they don't make up 75% of the year? So if Q1 through 3 don't equal 75% of the annual, then the firm has to do more smoothing in Q4? Is that the idea?
No, I guess what I'm saying is that the fourth quarter earnings would reflect not only a true up, but it would reflect sort of the management of earnings, which may be actually beneficial in such a way as to enhance the smoothing of annual earnings to enhance the predictability of annual earnings based on annual earnings. So in other words, the predictions regarding the fourth quarter adjustments may be different across the two systems because
Right.
of the integral versus a discrete.
Yep.
Okay,
In the
That's-
fourth quarter, in the fourth quarter. Yeah,
right.
yeah. Yeah, I like the option to think about something other than it being a true up.
Right.
So,
Thank
so one of the things that is true in the data that we didn't anticipate's the wrong word, but you can also see here that the cash flow predictability across these firms. So we've matched them on earnings predictability, but the cash flow predictability of US firms over IS firms is not the same. So you can see those stars across those quarters. When we were thinking about this, I suppose that my underlying bias is that earnings and accruals are useful and they measure phenomenon that are useful. So my prior wasn't that I wanted to match on cash flow predictability, but I think one of the questions that we've discussed and that certainly our reviewers raised, so trying to figure out how to get those apples to apples the same. I probably would have been happier if US firms' earnings were more useful, but IFRS cash flows were more predictable, and that's not the way it went. So I think we've been trying to decide whether we need to go back and match on cash flow predictability as well as earnings predictability. I feel like at some point I'm going to drive them into near oblivion trying to match them. And I think that gets at your point. If we were measuring usefulness some way other than our squareds, we could entropy balance these on a lot of dimensions and get away from that. But then we would have to figure out a way to measure usefulness that wasn't predictability. So we'll think about that a little more. And if you have suggestions, I'd appreciate them.
Cristi, I think Allison also has a question here.
Allison, the hand is blending into the picture in the back.
Sorry
on my
about that.
screen.
I'll change my color scheme.
No,
Sorry.
we're
about that.
perfect. Just your pasty hand.
Yes, pasty hands. That's right. That's what I have. So Bjorn did not kick you back one slide, but I was wondering if I might be able to do that. So there we go. So as I was reading the paper, and you actually made a comment on this slide that made me brave enough to ask my question. Is there something that's a little bit tautological about this, in that the integral method is supposed to behave this way? Do you view it that way, such that is your test really like, can managers apply the integral method? Can we kind of have good estimates that ends up in smoothing?
I think it's tautological for the high predictability.
Exactly.
So for the first two pairs, I think
Right.
it's tautological. I don't think it's tautological for the low predictability.
Exactly right. So when you sort on that predictability and you say, well, these are very the predictable group, and then the integral method behaves.
Right.
the way
That
it's
one's
supposed
fully expected.
Okay.
I think the surprising result is that it does provide. So if you think annual earnings predictability is more important than earnings predictability 4 quarters ahead, I think you'd stay quite happy with the integral method.
Exactly, because that's the point, right?
Yeah.
So, okay, I just want to make sure I wasn't missing something there. So is
No.
it people are applying it properly?
I think this is to some
objective.
extent evidence that even in the low predictability group, they're applying it properly. Yeah.
And so then it becomes more about, is this the way to go, right? Accounting design project, right? Then and
Right.
that's kind of more, okay, wanted to make sure
Yeah.
I wasn't missing that.
No, I think
Tautological
this is the surprising result, and that's that I think it's both good and somewhat surprising. If they were going to do it badly, it should be here. There's plenty of evidence across the accounting literature that the 4th quarter true ups are large and
Right.
make the 4th quarter useless. So it's somewhat surprising that their 3rd quarters are useful for predicting the annual amounts, and more useful than the discrete method where they're recognizing them earlier.
Okay,
Right.
Thank
So
you.
you might think they'd come out the same and they did not. Yeah, thanks.
in that piece, yeah, thank you, I appreciate it.
Yeah.
It was kind of the writing, I was like, is this really a hypothesis? Isn't this supposed to weigh, you know, we're expecting this kind of mechanically by
right.
the design of APB 28.
I think it's the design of APB 28. I think it is not mechanical, but pretty darn close. When earnings are high predictability, it would be hard to mess it up. But I don't think it's what you expect in the low predictability group. Yeah, thanks. Did I miss any other hands? Okay. Okay, just so that I'm a little bit complete, that result that cash flows are more predictable is also present to some extent in the low predictability. So we're trying to figure out how to manage that a little bit better. But when earnings are less predictable, IFRS also does better at predicting street earnings and cash flow from operations in a couple of settings, but in general, nobody does better across these things. So that's what moved us toward value relevance tests. It's probably the nudge of an editor saying, I can see why you don't want to do things like contract settings and debt covenants, but I think you ought to look at the stock market and investors' responses. And so we did that in two ways. And so maybe I think it might be easiest just to describe the models that we're using here. We just use a price levels regression, and our nested model, our base model, includes fixed effects, but not the effect of earnings. And so we look at the improvement from the base model, so the 39% to the 55%. Okay, and so thank you for letting me, show you my ugly baby. Because one of the things you'll see that I don't think we expected, and we've looked at a couple of papers that use international settings and US settings, but the comparisons are not apples to oranges. You'll see that the predictability of levels regressions for IFRS firms is really high. Particularly high compared to US GAAP firms. So when we look at the improvement in the R-squareds, maybe it's not entirely surprising that we find the improvement is higher for US firms relative to IFRS firms. So Stephen.
Yes, I was just thinking maybe a nice way to complement this is let's say I'm an investor who's interested in what my stock price will be after the annual earnings announcement. Go back to your ball and ground and think about that API graph as to how, in fact, the information comes in over quarters as you progress towards the final price. Excuse me, they're doing some renovations in the apartment next door. So you'd have to match it. Small firms versus large firms, the API graph looks very differently. Okay, so you have to be very careful with matching. But I'm interested in how quickly the information about the price that I'm interested in finally actually gets that information
At the quarters. Yeah.
And a nice graphical representation going back to our basics in the first class now. Seminar.
Well, and the mapping into the thing we're interested in is quite nice. Because that's really, we're interested, I mean, that is the underlying question, right? Is do the quarters provide information about the year?
Yeah.
And so I think it aligns nicely with the question. Yeah. So this isn't inconsistent with what we find with predictability. It has, I don't know, lots of questions for me and things that I don't have good priors about how to solve, like the vastly higher predictability and the price regressions for the IFRS firms. Okay, I can't tell you why I formatted that wider, except I just noticed it right now. Okay, that so you can see the predictability of the levels really drops here. We do find that the improvement is on the IFRS side in a couple of quarters and no difference. So that's not, I think these are fairly consistent with what we found in the predictability regressions. We also used returns regressions, and I'm going to show you one set, which is the ones that are adjusted for quarterly earnings with growth. That's certainly one of the issues in using returns regressions is getting a prior and measuring the unexpected earnings. So we generally find a lot more mixed results. You can see that in the third and fourth quarter, IFRS has a bigger increase in predictability. So I like Stephen's suggestion because I'm not sure that these gave me that these were as helpful as what we were hoping they would be, but it was a nice suggestion, I think, on the editor's part to give us somewhere to go. Okay, so back to Ayung's question a little bit about the earnings pattern and some of the things we worried about, and just maybe something that you've either thought about or have some experience with that would be helpful for us in thinking about what we want to do. One of the things we've worried about is how similar these firms are. And there are a couple of places where the differences are evident and they are just underlying features of the samples that I want to be really upfront about. And so we just differentiated whether firms had, so remember I told you I was going to use the word discrete way too much, US discrete items. These would be things, we identify these using things like CompuStat special items and one-time charge codes to single these items out. So this is not the discrete method. These are those items like gains and losses, litigation settlements, impairments, LIFO liquidations, if we had them in our sample and hadn't dropped them, things that get one-time charged out. And you can see that there are more of those, more observations in the US sample have those kinds of discrete items than observations in the IFRS sample. But that's not as important to us if those charges can be identified and pulled out of, I can see the hand, Stephen, I'll finish this and then I'll come back to you. That's not as important to us in how we're measuring earnings and evaluating it if those charges can be pulled out by analysts, and so, or presumably by investors. And so within these two groups, we looked at whether or not our street earnings is our proxy for whether those one-time charges are being pulled out by market participants. And you can see, I probably don't have the percentages calculated in necessarily the ways you want to do the math, but the percentage of observations that have discrete items where the items are being pulled out by analysts is much higher for US firms than for international firms. So there is a difference in the amount of adjustments going on in the analyst community, even conditioning on those types of charges existing in the sample. Okay, Stephen.
No, I'm sorry, Cristi, I bungled this reaction thing. I should have put my hand up.
No problem. You were looking for the clapping hands and you just raised
Yes, I was looking for that.
Yeah, good job. So, okay, so there is a difference there. And we've looked at a lot of the literature around analyst adjustments, and non-GAAP is the wrong term to use, but you know what I mean. Non-GAAP IFRS earnings, whatever the right way of saying that would actually be. And maybe that's a place where more research needs to occur in order to flesh that out. And so we've just tried to be really careful about it and really upfront about it. We also looked at whether the amounts of the adjustments are bigger, and they are definitely bigger. The difference between street and GAAP earnings is substantially larger than the difference between street and IFRS earnings. And that occurs across the distribution. It's not just driven by extremes. They are somewhat different. And so we thought maybe it would be useful. And I have a couple of things here that hopefully get back to Ayung's main question, and they were interesting for us and a little bit surprising for us. So for US GAAP firms, I want to focus on these bottom two rows in yellow and green, and particularly the SG&A lines. But these are the quarterly cost of goods sold scaled by the annual amount. And you'll notice that for US firms, these are very similar to about 25% of the annual amounts. So the cost patterns are very nicely integral. They are very nicely integral. The cost patterns for cost of goods sold are very similar for IFRS firms. So cost of goods sold behaves to a much greater extent like an integral expense under both. The difference is in the SG&A. So Ayung, you asked, where are these differences most pronounced? And I think it's fairly clear that the differences are most pronounced in the way SG&A costs are allocated. And that's the driver of where the differences in expenses impact earnings. And so I guess I know this factoid now, but it's not, it hasn't helped us think about better ways of matching. So after we identified this, it gobbles up a lot of data to try and match firms on similar intra-year cost patterns. I think that might be something I'd like to do. But the first couple of passes at that consume a lot of data without yielding a lot of benefit in the analysis. So if you have ideas about that, I would be super appreciative. Okay, so the last thing, I'm checking the clock to make sure I have a minute. So the US integral method is quite a compromise. It's actually a hybrid. It's not fully integral because it has those discrete items. And tax researchers are very familiar with those discrete items because most tax things, valuation allowances, settlements, all pop up as discrete items. And they create a lot of variation in what should otherwise be a good estimate of tax. And so we wanted to look at this compromise. And the thing that we see in, which is, I don't think surprising for a lot of capital markets researchers who think about quarters, but I do think it's important, is that GAAP earnings in each quarter are not better predictors of 4 quarter ahead GAAP earnings or of annual earnings in ways that make that hybrid useful. So as soon as you exclude the discrete items, it's a better predictor of cash flows, of GAAP quarterly earnings, and also annual earnings across the board. One of the, I guess, there's a large part of me in my conversations with our alumni who are executives. I'm sympathetic to their use of non-GAAP charges. And I think our evidence suggests that one of the reasons that firms continue to produce a lot of non-GAAP earnings numbers is that GAAP quarterly earnings with that hybrid method is less useful than excluding those discrete charges. In one version, because researchers can't be helped from trying things, we actually looked at some alternative ways of allocating those discrete charges. I can come pretty close to just excluding the discrete charges if you spread them out over the year. So if you just smooth them out, you can then earnings become a lot more useful. So if the FASB is determined to have them in, they should probably lean toward using an integral method across these instead of a discrete method, because it's the thing that reduces the predictability of earnings. Okay, so what do we think the implications are? In the setting where earnings are less predictable, in the way that markets think about earnings, which is particularly predicting earnings 4 quarters ahead, IFRS earnings appear to be more useful. As Allison pointed out, they're useful in predicting that annual earnings number, but it's not one of the largest uses of earnings by market participants. And the GAAP hybrid method for quarters seems to be particularly problematic in leading to non-GAAP disclosures. And I think my co-authors and I think it's probably time for both the FASB and the IASB to at least discuss whether quarterly earnings are useful. And Peter's question about semi-annual earnings, I think, gets at one of the issues that we know underlies this, and that's that some of these methods consume more effort in reporting and make it less likely that firms can report more frequently, which we think is useful. I can see a comment from Alina, and so I'll follow up with you, Alina, and I want to make sure I end on time. And so I think my biggest job is, I think all of us appreciate Ayung and Stephen and the opportunity to get feedback on papers here. And there aren't a lot of perks to a pandemic, but broad workshop series might be on the list of things that we really appreciate. So thank you. And so they are taking papers for the next semester. So the submission deadline to January 10th. So you can collapse after the end of your semester and still submit your work and send it to Ayung's email address. And you probably have another email from her on your email with your link today if you don't have time to copy this off right now. So thanks, Ayung, thanks, Stephen, and thanks everybody for your comments.
Thank you, Cristi. And thank you, Yuan. I think Stephen has something to say.
Well, what I want to have to say is very important. It's to ask you to join me in thanking Ayung for all the wonderful work she does for this accounting design project. It's a project we're very dedicated to, and she does all the work. I sort of sit in the background and dial in at 11 o'clock. So please, I don't know how you do the clap hands things on the doodle down here, but if you don't know how to do it, well, smiley face, please just add that to your screen as you leave the seminar. Thank you very much, Ayung.
Yeah, thank you, Stephen. Stephen deals with all the politics. I deal with the groundwork.
Politics.
Yeah. Yeah.
Thanks, Ayung.
Okay, I'm gonna stop recording.